Namaste. Good morning. This session is to ensure that we understand assessment of companies, especially the MAT provisions and the optional tax regime provisions. However, we start with understanding on a whole the outside provisions of companies, then walk into MAT, complete optional tax regime, and do some non-MAT question also, which again will bounce back to PGBP. So we should be able to do on a comprehensive manner. Assessment of companies. First is some special rates of taxation for some special transactions for a company. Special rates of taxation for some special transaction of companies. The preliminaries we all know, we have seen this in poem concept itself. What is a domestic company, what is a foreign company, etc. So directly into some of the special rates. This section I have been often referring, but now hitting at the provision. Section 115 BBD, dividend from a specified foreign company. Dividend received by the Indian company from a specified foreign company. Repeating, dividend received by an Indian company from a specified foreign company. That leads us to the question, what is a specified foreign company where I hold 26% of the more of the voting power, where the Indian company holds 26% or more of the voting power of a foreign company, then that becomes a specified foreign company. My intention is to bring the revenue into India. As a country, we should try to promote foreign exchange inflow. So the intention is, as investment money has gone outside India, as a return we should get money in India. So the rate of tax in case of dividend received from specified foreign company, the rate of tax is 15%, 15%, and no deductions or expenses can be claimed. Under section 115 BBD, if I am taxing it at a special rate, wherever I am taxing it at a special rate, no deduction or expenditures can be claimed. Next comes 115QA, tax on buyback. 115QA, tax on buyback, and the words unlisted is gone now. I have strike it off under, but here also I will strike it off. It is no more for unlisted. This provision, the amendment is 2019 onwards itself. is now available for both listed and unlisted companies. Even if a listed company buys back the shares, this provision is applicable. Let us understand the provision. This provision, my dear friends, says the difference between normally what happens buyback. Normally, this is taxable in the hands of the shareholder. The shareholder surrenders shares and gets consideration. The shareholder surrenders shares and gets consideration. So normally this is taxable in the hands of the shareholder. Okay, 115QA shifts the taxation from the shareholder to the company. Okay, what the section says is, I am no more going to tax the shareholder for this. Instead, I will tax the company. 115QA is shifting the responsibility of the taxation from the shareholder to the company. Okay, so the company pays. Okay, it is known as additional income tax. We have already seen when we read the transfer pricing provision, secondary adjustment not made, there is a additional income tax is one which is paid apart from the normal tax. Additional income tax is one which is paid by an entity, by an individual, by anybody, apart from paying a normal income tax. So here also it is known as additional income tax. Additional income tax is paid on difference between buyback price and issue price. Okay, additional income tax is payable on the difference between buyback price, the price at which I purchased back, and the price at which I issued the shares. The difference between buyback price and issue price, that will be treated as income, and on that you will be paying additional income tax. You will be paying additional income tax. And since the company pays the tax, it is exempt for the shareholder under 1034A. Only one point of taxation, company pays the tax. So the shareholder is not paying. If it is shareholder, at least he can claim cost of transfer, cost of acquisition, index the cost of acquisition, but all those things are lost. The company pays the tax for them, so the shareholder is not paying. The provision of this section is available for domestic companies, both listed as well as unlisted. Such companies are liable to pay income arising from buyback. So additional income tax at 20% plus surcharge of 12% plus HEC of 4%. Please understand, okay, these companies are paying 20%, surcharge is 12%, and HEC is this plus this into so they will be paying approximately 23.296, 24%. They will be paying approximately 23.296%, nothing but 24%, close to 24%. This surcharge is payable irrespective of the income of the company. Why I am saying this? Normally, if the income of the company is less than 1 crore, no surcharge. 1 crore to 10 crores, 7% is the surcharge, and more than 10 crores, 12% is the surcharge. But here, irrespective of the income level, surcharge will be 12%. Going by the interpretation of law, even if the company is not liable to pay income tax, even if the company is not liable to pay income tax, they have to pay surcharge. They have to pay surcharge at the rate of 12% and HEC at the rate of 4%. So even if you are not liable, even if your entire income is exempt, even if you are a loss-making company, still if you have made a buyback, on that pay surcharge 20% plus surcharge of 12%. Tax has to be paid within 14 days from the date of payment of consideration. Tax has to be paid 14 days, otherwise 1% interest for every month or part thereof. Otherwise, if you have not paid, 1% interest for every month or part thereof is liable to be paid. I told you that it is difference between buyback price and issue price. There can be various forms of issue. How to determine? In case shares have been issued by the company, primarily issue, that is, it can be first issue, rights issue, anything. Buyback price minus amount received by the company, including premium, if any. So, issue price is the actual issue price, 10 rupees shares issued for 50 rupees. So, premium is 40 rupees, 10 plus 40, 50 rupees becomes issue price. Okay, right? So, like that. ESOP, fair market value on the date of exercising the option. Fair market value on the date of exercising the option. That will be the issue price. Okay, this is taxable in the hands of shareholders as perquisite. Over and above that is taxable when the buyback happens. In a scheme of amalgamation, amount received by transfer or company for such shares, purchase consideration. In a scheme of demerger, it is a formula. What is the on the basis of total assets? What is the assets transferred divided by total assets will give you the number of shares. Okay, reverse working. Net worth in the case of conversion of firm into company, all the assets and liabilities should be taken over at book value. So you will have a net worth divided by number of shares. Bonus shares nil. Where shares have been issued for conversion of preference shares or debentures, the value, okay, amount received in respect of those instruments, debentures or preference shares. In any other case, fair value. So, shares issued for consideration other than cash, whatever is the fair value of machine coming in. Okay, so whatever is the fair value of the asset, okay, all those things. Okay, this is the issue price. Buyback is equal to or the income is equal to buyback price minus this issue price. On that, tax is payable at 20% plus 12% plus 4%. So go for the buyback price minus whatever may be the issue price. When you have directly made an issue, whatever you collected. ESOP, excise of option, amalgamation, conversions and all based upon purchase consideration, the number of shares allotted. Demerger, okay. What is demerger? One company splitting it into two. So I only, that is the parent company only got the money. I issued 1 lakh shares and got some 1 crore. Now one of the unit I am demerging. My total asset value is 200 crores. 50 crore worth of unit I am demerging. 1/4 of the assets I am demerging. 1/4 of my share value loses, because to that extent my share value comes down. So amount received for such shares into net book value of assets transferred, that is 50 crores, divided by net total assets. Owner shares nil. Conversion of debentures or preference shares, amount paid for such debentures or preference shares. In any other case, the fair value of shares. So 115 BBD is one of the provisions which we studied. Foreign companies dividends, specified foreign company. 115 QA. 115 QA. What did we study? Buyback of shares. Okay, these two we will address some questions and come back again. These two we will understand some questions and come back again. I should be in page number 299 for you. I should be in page number 299 for you people. Question number 1. Hastinapur Limited held 30% shares in the capital of Kandhar Limited, a company located in Middle East. The total income of Hastinapur Limited 76 lakhs, which includes dividend received from Kandhar Limited 18 lakhs. Compute tax payable by Hastinapur Limited, assuming that the company is in 25% slab. Computation of tax payable by Hastinapur Limited. Tax at the rate of 15% under section 115 BBD in respect of dividend received from domestic, also from specified foreign company. Tax at the rate of 15%, okay, in respect of, so I received 18 lakhs, on that I need to pay 15%. On that I need to pay 15%. Okay, okay. Tax at the rate of 25% on balance income. What is the balance income? 76 lakhs minus 18 lakhs. 76 lakhs minus 18 lakhs. Okay, so total income is 76 lakhs minus 18 lakhs, 58 lakhs into 25%. So my total tax is this. Add HEC at 4%. There is no surcharge because the total income is just 76 lakhs. Okay, total tax payable. Okay, okay. Question number 2. H Limited, the Indian company, taxable at 25%, declared a total income of 1 crore 40 lakhs. The total income includes the following dividend. Dividend from a specified foreign company, 12 lakhs, 15 lakhs. So totally 27 lakhs because both are more than 26%. So 27 lakhs. Dividend from domestic companies, 25 lakhs, 20 lakhs. That doesn't have any specific provision. Now dividend is taxable in the hands of the recipient. Dividend is taxable in the hands of the recipient, so it is taxable. The company declares a dividend of 75 lakhs for the year ended 31st March. Compute the various tax payable by the company. Compute the various tax payable. So the company has declared a dividend of 75 lakhs. I am coming to a question of ATM also. I am coming to a question of ATM also. Question number 2. Okay. Gross total income, which is what is given to us as 140 crores. 1 crore 40 lakhs, sorry. 140 lakhs. Deduction under section ATM. Deduction under section ATM. We all know, but anyhow to recollect, what is this section saying? Dividend received. The wording is dividend received. So it will include all types of dividend. Dividend from domestic company, dividend from business trust, dividend from foreign company, everything will be. They have not said dividend from domestic company received or dividend from a subsidiary company received. They have just used the terminology dividend received, which will mean domestic company plus if there is any business trust dividend, that also, plus foreign company, all dividend will be included. So it will be 12 plus 15 plus 25 plus 20. Okay, 12 lakhs plus 15 lakhs plus 25 lakhs plus 20 lakhs. Okay, dividend received means dividend from domestic company, business trust, foreign company, everything. Dividend distributed on or before 1 month prior to the due date of filing returns. Okay, the question is silent. It is assumed that it is distributed, that it is declared and distributed accordingly. So the question is silent. So we take a favorable assumption that it has been distributed, okay, within 1 month, 75 lakhs. Okay, we take a favorable assumption. So minimum of these two things, whichever is less, is allowed as deduction. So my total income will be 140 minus 72, 68 lakhs. Repeating, dividend received 72 lakhs. When I say dividend received, all types of dividend to be included to avoid the cascading effect. These dividends are no doubt taxable in the hands of the recipient. To avoid that cascading effect, the law now gives us the benefit. Whatever dividend if you have received, you have distributed, I will give you deduction. So that only the ultimate beneficiary, that is the shareholder, is taxable. Computation of tax. Dividend from specified foreign company taxable at 15% under 115 BBD. How much is that? 12 plus 15, 12 lakhs plus 15 lakhs, okay, 27 lakhs into 15%, okay, tax at the rate of 25% on other income. Okay, so 68 lakhs minus 21 lakhs, 41 into 25%. Total base tax. And HEC at the rate of 4%. Total tax payable. So why dividend is taxed as it is available after taxing? Why dividend is to be taxed as it is available after taxing in the hands of the company? Yeah, it is doubly taxed. Yes, friend, it is doubly taxed. Once in the hands of the company and another in the hands of the recipient, it is doubly taxed. I agree with you. Till last year, triply taxed. Company was also paying dividend distribution tax. Recipient, if the income dividend exceeds 10 lakhs, he is also paying. Question number 3. Virat Limited, ஃபார்முக்கு வரமாட்டேன்றான். Virat Limited bought back 70,106 shares at 106 per share. Compute the tax payable to be paid, to be considered, tax liable to be paid after taking into consideration the following. The buyback can be identified as follows. 20,000 shares issued by the company at a premium of rupees 20, face value 10, so issue price 30. 20,000 from ex-employee to whom it was allotted as ESOP. On the date of exercising option, it was 50. 20,000 shares for issued for consideration other than cash. The company obtained a technical know-how. The cost of technical know-how is 80 lakhs and 1 lakh shares were allotted for that know-how. and 10,000 shares were bonus shares. Computation of income for additional income tax. Okay. Total shares, total consideration for buyback. You bought 70,000 shares into 106 per share. The company bought back 70,000 shares into 106 per share, less issue price of 20,000 shares. 20,000 into, I issued it for at a premium of 20 face value, so 30. Okay, 20,000 into 30, 6 lakhs. 20,000 into 30, 6 lakhs. Okay, right? Sweat equity shares. Okay, ESOP. Okay, FMV on the date of exercising the option. So 20,000 into on the date of exercising the option, the amount credited to capital was 10 and securities premium 40. So totally 50. For consideration other than cash, that is, I got a technical know-how worth 80 lakhs. Of that, I allotted 1 lakh shares for that, and I got back now 20,000 shares. Repeating, I allotted 80 lakhs worth of, I got a 180 lakh worth of technical know-how by allotting a 1 lakh shares. Now I am getting back 20,000. Now I am getting back 20,000. 80 rupees per share. Now I am getting back 20,000. For bonus issue, it is nil. So, net difference. Net difference is 7420 minus all these things. 42 lakh 20,000. 42 lakhs 20,000, my dear friends. Okay, 42 lakh 20,000, right? Computation of additional income tax. computation of additional income tax. Additional income tax at the rate of 20%. Same LTCG rate. Okay, 20%. And okay, surcharge, surcharge at the rate of 12%. Surcharge at the rate of 12%. And HEC at the rate of 4%. Okay, that is on tax plus surcharge into 4%. Total additional tax payable. Total additional tax payable. Okay, this is apart from the income tax which we pay. So it is popularly known as additional tax. So it is popularly known as additional tax. Note, additional tax is payable within 14 days of payment of consideration for buyback. Additional taxes payable within 14 days of payment of consideration for buyback, where it is not paid interest at the rate of 1% for every month or part thereof. Even one day will be taken as 1 month, is liable to be paid. Where you are not paying the additional tax, then do one thing, pay interest at the rate of 1% for every month or part thereof. Okay, so even one day will be taken as 1 month. Okay, even if he is paying late by 42 days, it will be 2 months. It will be 2 months. He will be liable to pay interest. Okay, okay, this is with regard to additional income tax. Now moving forward, my dear friends, I'm taking two other provisions before going into 115 JB. Okay, First provision is, though it is not only for companies, I'm not saying this is only for companies, it is for all assessees, but it is important to understand at this juncture so that we can approach 115 JB with confidence. This is royalty income for patents developed and registered in India. Shall we repeat that heading? 115 BBF, royalty income for patents developed and registered in India. The terminology registered in India, you will all be clear that it should be registered under the Indian patent law. It should be registered under the Indian patent law. What do you mean by developed in India? 75% of the development cost should be incurred in India. Shall I repeat? 75% of the development cost should be incurred in India. That is what is known as developed in India. Okay, I am repeating. Royalty income for patents developed in India means 75% of the expenditure should be incurred in India. Then I will accept it is developed and it should be registered in India. Okay, so today royalty is the greatest asset a person can have. Okay, so the rate of taxation is 10%. Of course, I will not give you any deduction. I will not give you any deduction for that. Applicable for all assessees who is resident, first inventor and registered under the Indian Patent Act. Not only for companies, for all assessees, I am taking it along with companies, but even individuals, firms, etc. can claim. Royalty will include both the lump sum or anything transfer of imparting knowledge. We already know, we have seen this definition. Now even film is a royalty. For availing the concessional rate, the patent should be developed in India. When I say developed in India, 75% of the expenditure should be incurred in India by the assessee. Tax is 10%, no question of claiming any deduction. When the tax is special, deductions will not be allowed. Assessee has to opt for this scheme before filing his first return of income. Whether you want to go by 115 BBF or normal provision. Normal provision, what is the benefit? 80 QQB. 80 RRB, royalty income for patents up to 3 lakhs. You can claim deduction. We saw that in DTAA also. So see, there you can claim all the expenses, but you should pay normal tax. Here you cannot claim expenditure, but tax is only 10%. So which one you want to? Having opted, you cannot lock-in period 5 years, and if you walk out within that 5 years, again locked, both sides locked. You can never come into the scheme for the next 5 years. I'll tell you what is provisions of MAT not applicable. Similarly, for emission, greenhouse, for those who are generating lesser pollution, a certificate is given which is tradable and the same is taxable at 10%. No expenditure can be claimed. Again, for all assessees, not very popular, 115 BBG. BBF, a royalty, BBG, carbon credit. Rates of taxation of a company. If the turnover does not exceed 400 crores in the financial year 1890, 25%, otherwise 30%. That's only for domestic company. Always for a foreign company, the base rate is 40%. Surcharge, where the income exceeds 1 crore but does not exceed 10 crores, 7% and 2%. More than 10 crores, 12% and 15%. HEC 4%. A quick read through before me starting to explain what is 115 JB. So, may I walk into 115 JB? What is that? Like AMT, companies also have something known as MAT, minimum alternative tax. Companies also have something known as minimum alternative tax. So they are liable to pay minimum that tax like AMT, but it is not simple. It is a format. 115 JB is a format. 115 JB is a format. The format is divided into two. Actually, not divided. There is an extension. I need not say divided. The format is up to 111. Okay, the format is up to one level for all domestic companies and or actually all companies, not even domestic company, even a foreign company. The format is up to one level for all companies, and then the extension is only for companies which is opting for or which has to go by Ind AS. Shall I repeat? The format by itself is for all companies up to one level. The extension to the format, we call it as subsection 2. And then they say 2A, 2B, 2C, three specific subsections only for companies which opt for or which has to mandatorily go for Ind AS compliance. Let me tell you what is the purpose of 115 JB so that you are very clear. It is same like AMT. Companies, I don't want to give them or they are making profits but not paying taxes because they were claiming it as exemption, deductions, etc. As per books of accounts, they have profit. They in fact even declare dividend. But when it comes to income tax law, they were not paying taxes because that profit is exempt, or that in income tax act you can claim deduction. Let me take the popular section. Section 35 AD. As per books of accounts, can you claim those capital expenditures? As per books of accounts, the answer is no. You cannot claim, because books has to be as per the accounting standards. Accounting standard says asset should be capitalized, so you cannot claim deduction. So in the books of accounts, only depreciation would have been claimed. Only depreciation would have been claimed. They would not have claimed this 35 AD. In the books of accounts as per income tax law. What is books of accounts as per income tax law? Income tax adjustment statement. In the books of accounts as per income tax law, what we do? Add expenditures, less 35 AD deduction, less 35 AD deduction. Okay, look at this question. Raja Boga Limited, we did the question. Okay, we said gross income less allowable expenses less 35 AD. Actually, if you look at that question, they would have given you depreciation. As per books of account, depreciation would have been only charged. Okay, we worked out a special question for 35 AD, if you remember. X limited no question. Okay, we tested the condition of plant and machinery, etc., and we worked out that question. Okay, look at this. New plant and machinery 15 lakhs. Expenditure, all these things. Net profit as per P&L, add depreciation on building, add depreciation on plant and machinery, add cost of know-how. Okay, all less expenditure, and as per books of account, I had a profit, because I would not have claimed this capital expenditure as deduction. As per books of accounts, I had profit, but when I reworked for income tax law, I get a loss. I had profit as per books of accounts. I would not have paid taxes, because when I reworked for income tax law, I got a loss. So came a concept called, if these companies can make profit, earn dividend, even declare dividend, why should not they pay tax on the book profit? On the book profit. Book profit means as per books of accounts, but that is not sufficient alone. Books of accounts, you would have made a lot of changes. So the format was dictated under 115 JB to say what adjustments has to be made. Shall I repeat? What adjustments has to be made to the book profits? What adjustments has to be made to the book profits? And then tax will be computed. This is the sanctity of bringing the provision. so that you are claiming exemptions or expenditures or deductions and not paying tax. What are all the adjustments that will be warranted to be made? What are all the adjustments that needs to be made? First thing is, the net profit should be prepared as per mandatory accounting standards. The net profit should be as per the standards. And then items debited to P&L will be added. Items credited to P&L will be reduced. Shall I repeat? Items debited to P&L will be added. Items credited to P&L will be reduced. What are all they? There is an easy way of remembering this. 24 items. There is an easy way of remembering. That's what I'm trying to make the class understand. And all appropriations. Okay? Appropriations. Okay? First, add all appropriations. The three popular appropriations. The three popular appropriations are dividend, reserves, taxes. Tax is also an appropriation. So shall we? Dividend, reserves, taxes. Add back. If appropriations is credited to P&L, reduce. When I say tax, I mean both the current tax and deferred tax. The first 6 items I ask you to remember is any dividend which has been debited to P&L. Now the format is different, but the law gives this format. Now dividend is taken to reserves, we all know in schedule 3, but the law format is this. Any dividend that is debited to P&L, add back. Any transfer to reserves that is debited to P&L, add back. Any deferred taxes, if it is debited to P&L, add back. Any type of income tax, interest on income tax, DTT, penalty, add back. And reduce if dividend is transferred from reserves or deferred taxes is credited. There are 3 types of provisions which needs to be added back. 3 types of provisions. Provision for contingent liability, provision for contingent liability, provision for diminution in the value of investment, provision for loss of subsidiary company. Okay, the next 3 are provisions. The next 3 are provisions which will be added back. The 3 types of provisions that are added back are provision for contingent liability, provision for bad and doubtful debts, provision for loss of subsidiary, that is not your loss, separate entity concept, provision for diminution in the value of investment according to AS 13 you would have done. There is no income, but there is one item which will always be profit on second industrial undertaking. Chuma, I have written it there. That is not important at all. Okay, okay, okay. This you understood? So can I repeat the first 8 items you have understood? Appropriations. The appropriation consists of taxes, current and deferred, transfer to reserves, dividend. On the income side, I should reduce transfer from reserves and deferred tax credit. The provisions consist of provision for contingent liability, provision for diminution in the value of investment, provision for loss of subsidiary company. Though it is not a provision, I am taking out here profit of sick industrial undertaking. What is the purpose of 115 JB? Before availing exemptions, they would have got income. I want to pull it off. Very, very slowly, but very clearly. I am starting from the income side, going to the expense side. I am starting from the income side. Please understand. Incomes exempt under section 10, we will be reducing. Remember, I have only said 10, not 10AA. Agricultural income, share of profit of a firm, income exempt under section 10, reduce it, any expenses pertaining to that income, add it. It's a direct opposite. Income exempt under section 10. Sir, in the credit side of my P&L account, I have agricultural income. The company has agricultural income. Agricultural income is exempt, be it under normal computation or be it under 115 JB. So I will put less agricultural income and expenses pertaining to that agricultural income. Agricultural income I am not going to tax. Okay. Share of profit of a firm is in section 10, subsection 2. Share of profit from AOP is in 86. So there is a separate line item. Otherwise, I would have. So share of profit of AOP reduce, share of loss of AOP add back. Shall I repeat? Share of profit of a firm, I did not write it separately because it is there in section 10. Unfortunately, share of profit of AOP is not in 10. So I have one more line item. Share of profit of AOP reduce, share of loss of AOP add. We just studied in 115 BBF. If royalty from patents developed and registered in India, the tax is 10%. The tax is 10%. And then I go and tell to them, pay 10% or MAT, whichever is higher. MAT is 15%. I tell them here, boss, your royalty income from I will tax it at 10%, boss. I am taxing you at 10%. And then I come and say, but anyhow, boss, you do one thing, pay 10% or 15%, whichever is higher. He will say, Poda. If you say 10%, stay to 10%. Otherwise, change this section itself is 15%. So came this. So, if at all I have any income, royalty under 115 BPF, I will reduce because I will tax it at 10%. No expenses are allowed, so I will add back. The same is for foreign companies. MAT is also applicable for foreign companies. For foreign companies, fortunately, now, since you have studied international taxation, it is easy for me to explain. Royalty or fees for technical services, tax that 10%. Interest from infrastructure bonds 5%. Interest on RDB and other things IFSC 4%. Now I go and tell them 10% or 15%, whichever is higher. 5% or 15%, which income of foreign company which is taxable at a rate lesser than 15%. Interest, okay, royalty, fees for technical services, that 112A is LTCG. Add those expenses. Notional gain on getting the units of REIT. Yesterday I told you, shares are surrendered, units are obtained. The next 10 items I have now tell you, 10 items I have told you now, are all exemption based. Okay, don't even worry, it's simple. Exemption under section 10, income which is exempt under section 10, reduce, expenses add back. Share of profit of AOP reduce, share of loss add back. 115 BBF income reduce, expenses add back. Income of a foreign company which is taxable at less than 10%, 15% add back expenses, reduce, add back expenses. Notional gain on REIT, reduce, notional loss, add back. Income tax law does not recognize the concept. Income tax law does not recognize the concept of revaluation. Income tax law does not recognize the concept of revaluation even if it is for books. So whatever depreciation charged in the books add back, I am reducing not depreciation as per IT law. No, I am reducing depreciation of books other than for revaluation. That's all is the difference. I am not reducing depreciation as per IT law. I am also reducing depreciation as per books, but if there is any revaluation, I will take out. And finally, brought forward loss or unabsorbed depreciation, whichever is less as per books. Brought forward loss or unabsorbed depreciation, whichever is less as per books. And from the top, I am coming back. From the top, I am coming back. Now you are not referring to the material. You are just repeating along with me. First is appropriation. There are 4 types of appropriation: income tax, current and deferred. Provision for, a transfer to reserves and proposed dividend or interim dividend. Any transfer from reserve and deferred tax creditor will be reduced. Next 3 items of provisions are provision for contingent liability, provision for loss of subsidiary company, provision for diminution in the value of investment, any income reduced. Next 5 items reduction and its additions are related. Income exempt under section 10, reduce expenses add back. Share of profit of AOP, reduce, share of loss add back. Income which is taxable under 115 BBF, reduce, expenses on such income add back. Income of a foreign company which is taxable at a rate lesser than 15%, reduce, expenses add back. Notional gain on REIT, reduce, notional loss add back. Ignore revaluation. So add back depreciation, reduce depreciation as per books other than revaluation. Finally, brought forward loss or unabsorbed depreciation, whichever is less as per books. If you reduce, you will get first level income. Leave this part I'll come to this. You will get first level, that is before making Ind AS adjustment, and 115 JB is 15%. Tax credit mechanism is similar to what we have studied in 115 JD. Okay, quick read through, we are going to solutions. I am in your page number 303, Hyper Limited, engaged in diversified activities, earned a net profit of 14,25,000 after debiting or crediting the following items debited: provision for loss of subsidiary, provision for sales tax demand paid before due date, wealth tax, income tax, expenses on purchase and sale of equity shares, depreciation, interest on deposit credited to buyer, TDS deposited in October 21. Okay, October 21. LTCG on sale of equity shares on which STT is paid 360. Income from units of UTI 75,000 taxable from this year. Till last year there was an exemption, one with DDT, now it's taxable. The company provided for following additional information. Depreciation in the books includes 1,50,000 on account of revaluation of asset. Depreciation allowable as per IT law 2,80,000. Brought forward loss as per books as per income tax law. You are required to compute the total income of the company, giving reasons of each treatment. You are also supposed to examine 115 JB and compute the book profit and tax credit to be carried forward. Read through. all of us in the classroom, please listen what I am saying. In examination, you cannot work out like this. I will tell you how to work out in examination. But your understanding will be best if you work out like this. That is why I am taking a different working style. All of us in the classroom, please understand, in examination, you are not supposed to work out like this. But here, I am going to work out like this. I will tell you how to work out in the examination. Here, I am going to work out like this because you will be able to understand the whole answer with a different dimension. Particulars as per normal provisions as per 115 JB. Now you are going to work out. Draw neat lines in your notebook also so that you will be more clear. What is the difference between this normal provision and 115 JB? You will be able to appreciate. Net profit as per P&L account. Net profit as per P&L account 14,25,000. 14,25,000. Provision for loss of subsidiary. In both the cases, it is not allowed. Obviously, in our normal provision, other provisions, contingent provisions will not be allowed. In 115 JB also, it is not allowed. One small adjustment I will make. This is the question, but one small adjustment we will make to understand the question better. Okay? Instead of before, can I take it after? So that I can make you understand what is the difference it makes. Okay? Instead of before, I substitute it with after. Original question it had only had before, but I am substituting it with after so that I am able to make you more clear, make you understand what it is. Statutory due paid after the due date. Section 43B disallowance. Section 43B disallowance 75,000. Here it is nil. Because the format is not saying so. The format is not saying that I should disallow there. Wealth tax 90,000 disallowed. Here it is not there. Why? The format only says income tax. I want the class to understand 115 JB is format based. You cannot include or exclude an item from the format. Whatever the format says, we know 6 plus 4, 10 plus 10, 20 plus 3, 23 items in the format we know. That can only happen here. You cannot otherwise happen anything. Income tax 1,05,000, 1,05,000 because in the format it is set. Expenses on issue of expenses on purchase or sale of equity shares. Okay, 15,000 There is nothing. Foreign companies which are taxable at a lesser rate only given, not domestic companies. For domestic, only 115 BBF. Depreciation. In both the cases, I will add back 3,60,000. In both the cases, I will add back 360. %, of interest as tax is remitted after the specified date. Okay. Section 40 disallowance, TDS default, 90,000 into 30%, and nothing is there here. The format does not say so. The format does not say so. LTCG on sale of listed shares, taxed separately. In capital gains, we will tax it. 3,60,000. Dividend from mutual funds, taxed separately. 75,000. Whereas nothing here. Nothing on the other side because the format has not said so. Till last year, this income was exempt under 10. So I would have written here also. Depreciation, ignoring revaluation. Okay. Depreciation includes 150 for revaluation of fixed assets. So total depreciation 360, 360 minus 150. Depreciation as per IT law, 2,80,000. So you understand line wise how it is traveling. 115 JB is format based. Okay. Okay. Brought forward loss or unabsorbed depreciation, whichever is less as per books. Brought forward loss or unabsorbed depreciation, whichever is less. You should cumulatively see, not year wise. You should cumulate 570 or 250. Okay, to be checked cumulatively and not year wise. Okay, so how much? 570 or 250 minus 2,50,000 minus 2,50,000. At this level, I complete book profit as per 115 JB. Profit as per 115 JB, which comes to 15 lakhs. Let me keep it. I'll work out the normal. So in examination, first we will work out normal provision under that book profit. Like how we did 115 JC MAT AMT provision. First I worked out the total income, tax on total income. Okay. In examination, you will first work out normal, then work out taking the same profit, book profits. Here I am simultaneously work out to make you understand how an adjustment will be seen from the normal perspective and from the book profit perspective. But when you work out the question in examination, don't work out in column now. They are not accepting. Okay. Here what I am getting is business income. Here what I am getting is business income okay, less brought forward loss, less brought forward loss 2 plus 1 3 lakhs less unabsorbed depreciation brought forward, okay, which is 2.5 plus 1.8, 2.5 plus 1.8, 4.3 lakhs. So business income net is, here I can reduce both, whereas there only one. 7,22,000. Wait till I complete. Let's go slow. Business income is 7,22,000. Capital gains. The question itself says LTCG. They have not given sale value. LTCG on sale of shares. LTCG on sale of listed shares, okay, to be taxed under 112A is 3,60,000. The question came when this was exempt. Okay, that's why they have given it like this. The question, original question, the year in which this question came, this income was exempt. Okay. Other sources. Dividend from mutual funds, 75,000. Gross total income slash total income, gross total income slash total income is 11,57,000. Computation of tax. Again, I follow the same system, normal book profit. Okay. Computation of tax. 15% of book profit as computed under 115 JB. 15% of book profits as computed under 115 JB 2,25,000. 10% on LTCG exceeding rupees 1 lakh under 112A. That is, I have 3,60,000 minus 1 lakh into 10%. 3,60,000 minus 1 lakh into 10%. Balance income at 25%. I assume it to be 25%. That is 11 lakh 57 minus 3 lakh 60,000 into 25%. Okay, nothing but 11 lakh 57,000 minus 3 lakh 60,000 into 25%. So what is the base tax? So almost my normal is better, and HEC at 4%. Total tax since normal tax is higher, the same is payable. Since normal tax is higher, the same is payable. No tax credit. So, since normal tax is higher, if only 115 JB tax is more, the tax credit will come. Patiently look through. I'll join you. So 115 JB is format based, and this is how it has to be worked. Netherlands Oil Corporation is a foreign company. The base rate of taxation is 40%. Engaged in exploration of oil and gas in all countries, including India. In respect of its Indian business, the company has prepared the profit and loss account in accordance with the Companies Act, and such P&L shows a net profit of 65 lakh. The net profit of all other countries, that is an irrelevant information given just to confuse. Do not get it. The company informs that while preparing the net profit as indicated above in respect of Indian, the following are the debits and credits. Credit: agricultural income in India, share of profit from a firm, amount withdrawn from reserve, income from an industrial undertaking covered and qualified under 80IC. Debits: depreciation, interest to financial institute not paid up to the due date of filing return, penalty, propose the dividend, provision for taxation, transfer to reserve, provision for contingent liability, expenditure on 80IC undertaking. Brought forward loss as per books, depreciation as per IT law, brought forward loss and depreciation as per IT law, compute the tax liability. Whenever they say compute the tax liability, we need to work out book profit 115 JB also. Only if they say ignore math, 90% of the question will say ignore math. But when they say compute the book profit, compute the tax liability, we have to work out both. Quickly read through. Can you repeat brought forward loss and unabsorbed depreciation? Yes, friends. With regard to 115 JB, brought forward loss or unabsorbed depreciation, whichever is less as per books of accounts. Because it is known as the book profit, it is whichever is less as per books of accounts and not as per IT law. Book profit. If in the books of accounts loss is there or unabsorbed, whichever is less. And second point to remember, if they have given information for more than 1 year, accumulate and see. Year-wise, don't check brought forward loss or unabsorbed depreciation, whichever is less. Cumulatively, brought forward loss or unabsorbed depreciation, whichever is less as per books you need to see. Whereas in our normal income tax computation, both will be reduced. Net profit as per P&L account. ₹65 lakhs. Adjustment. Agricultural exempt under section 10 subsection 1. In both the cases it is exempt only. (115) JB also says reduce all exempt income under section 10. Only difference is 10 AA. Okay. Share of profit of a firm exempt under section 10 subsection 2. Amount withdrawn from reserves. Depreciation as per books. There is no revaluation, nothing to add back and reduce. Otherwise, you should add back 24 lakhs, reduce 24 lakhs. There is no revaluation. 115 JB is only as per books. If at all there is revaluation is there, that needs to be ignored. No revaluation, just leave as it is. Interest paid after due date is allowed under section 43B. Disallowed under section 43B, 6 lakhs. Here nothing. Nothing is disallowed. The format does not warrant us so. Penalty 1 lakh. Nothing is disallowed. The format does not ask us to disallow penalty. Penalty is not disallowed. Proposed dividend in both the cases, since it is debited to P&L, it is disallowed. Provision for taxation. Transfer to reserves. Transfer to reserves. 5 lakhs, 5 lakhs. Provision for contingent liability. Depreciation as per IT law. Depreciation as per IT law 30 lakhs. Brought forward loss or unabsorbed depreciation, whichever is less as per books. Please understand. Brought forward loss as per books is 12 lakhs. Brought forward loss as per books is 12 lakhs. Brought forward loss as per unabsorbed depreciation, 0. If there is no information, I cannot take this is only is less. There is no unabsorbed depreciation brought forward. Brought forward loss as per books is 12 lakhs. Brought forward loss as per unabsorbed depreciation is nil. Since unabsorbed depreciation is not specified, it should be assumed as nil. So whichever is less, nil. Profit. $43 lakhs. Profit 43 lakhs. Here, business profit, I have a lot of things to work out here. Business profit $44 lakhs. Business profit, I am getting 44 lakhs. Less brought forward loss and unabsorbed depreciation. Loss is 10 lakhs, so totally 18 lakhs. Totally 18 lakhs. Gross total income. Gross total income. Gross total income 26 lakhs. Deduction under section 80 IC. Deduction under section 80 IC 100% of profits. What is profit? 6 lakhs is income, 5 lakhs is expenditure, 1 lakh is the profit. Repeating, 80 IC, income is 6 lakhs from that, expenses is 5 lakhs, 1 lakh. This is not an exemption, this is a deduction. So after giving gross total income only, I will give. After arriving at gross total income only, I will provide for exemption. So total income. Computation of tax. Normal tax at the rate of 40%. Remember, foreign company. 15% on book profits. So normal only is higher. Here itself we are very clear. Normal only is higher. Not an examination question. Not an examination question. Passion has driven me towards that question. Sheer passion, okay, towards the subject has driven me to that question. I'm going to do that question now. Not an examination question, but just a recollection of provision question. So please don't worry, don't get, but you will understand a lot of things by doing that particular question. Not the third question. Third question is in the years. So we will complete, I mean, sixth question. Seventh question, not an examination question. Don't worry. Georgette Limited is in hospitality business, running resorts and hotels. The following information are provided. Compute the income of the company along with tax liability. Net profit after all adjustments. Provision for taxation created and charged to P&L. Net profits includes net profit of new hospital which is eligible under 35 AD. Dividend debited. Depreciation including revaluation. Deferred tax liability. Loss of subsidiary. Provision for gratuity. Expenses on higher studies of director's son. We all know XJ forging's case. If this is the only expenditure, not allowed. Company has taken a village as part of CSR. Okay, not allowed CSR expenditure as per the circular of CBDT. Technical fees paid to subsidiary company for product design and development for subsidiary company. So we should remember 48(2). Unfortunately, the company failed to deduct tax at source when payment was made. However, it deducted only in April. 8.1 lakh. Further understood, fair market value is only 5.2 lakh. Legal expenses for defending suit allowed. No specific provision. Guarantee commission paid to a director for extending personal guarantee. I told you it is allowed. Commission paid to a director for extending personal guarantee. In PGBP we saw. Something extra the director is providing, it is allowed. Interest on overdraft taken for payment of dividend allowed. Only interest on payment of income tax not allowed. Diminution of investment. provision for bonus, 80% of the were paid in September and balance were not traceable as they have left the organization. Company reversed it in 21-22 only. Sales promotion expenses includes neon signboards put up, okay, which is allowed as an expenditure. Out of this, you understand 0.02, that is, we are doing it in lakhs. So 20,000, we are doing it in lakhs of crores, so amount in crores, sorry, 0.02, okay, 20,000 was paid on cash. VRS paid to 11 employees who opted out during this year. Feasibility studies conducted into the new areas of treatment that resulted in failure. Priya Village Roadshow case, it is allowed. Cost of transformer, company has incurred the cost, but the transformer is given to State Electricity Board. Old case law, I will come to that. Regularization fees paid. Millennia Developers case law says regularization fee is like a penalty, so it will be disallowed. Donation, dividend received from foreign company, interest on deposit, profit on sale of land. Additional information, actual gratuity for the year amounted to 35 lakhs, which was adjusted against the provision. Analysis of plant and machinery, opening WDV, more than 180 days, less than 180 days, depreciation of all other assets. Brought forward items as per books, as per IT Act. Assume that in computation of profit of specified income business as declared in the P&L account is the same for income tax purpose also. Details of land sold. Sale consideration 5.15. Land was purchased in May 2016 for 2.7 for a housing project. Shelled out due to feasibility study proving negative. Investment of 60 lakhs were made. Okay, very lengthy question, not an examination question, but always we have every line item when we go, it becomes very simple. Every line item when we go, it becomes very simple. I want you to read it once before going so that we complete this question and then take the break. You'll always remember this question because you will feel that I have understood a lot of things, or you will feel that this man is too much made me to work this question. Computation of eligible depreciation as per IT law. Let us first start from there so that we are clear. Computation of eligible depreciation as per IT law. It's not a manufacturing company, we all know. I'm working out in absolute values. Opening WDV, okay, 40 crores. Additions, okay, put to use for more than 180 days or for 180 days or more is 14 crores. put to use for less than 180 days is 11 crores. No deletions, less depreciation. Okay, this into 7.5% plus these two into 15%. 54 crores into 15% plus 11 crores into 7.5%. Okay, closing WDV total depreciation for equipments and other assets. Okay, for other assets 4 crore 10 lakhs. For equipment I have computed 4 crore 10. So this plus 4 crore 10 lakhs. This is my total depreciation as per IT law, with the remembrance that put to use more than 180 days full depreciation. It's not a manufacturing entity to claim additional and all. It's hotels and resorts. It's hotels and resorts. Okay, right. Computation of total income and book profits. If you want, we'll do it in crores because you will find it difficult to put so many zeros. We will do it in crores. Okay. Net profit as per P&L account. Net profit as per P&L account 152 in both the cases. We are doing it in crores only. Okay. Adjustments. Together travel with me. Together travel with me. Provision for taxation 48. Provision for taxation debited to P&L 48. Income of specified business considered separately because you have a brought forward loss for that 6.15, whereas no such adjustment here. I cannot consider it separately over there. The purpose itself is that only. 6.15. Dividend 18.10. Depreciation as per books 16.35. Here also 16.35. Here itself I will make the adjustment, okay? Though you can make it later, but here itself so that I don't forget. Depreciation by ignoring depreciation by ignoring revaluation. So here it is 3.75, okay? 12.60, 16.35 minus 3.75, 12.60. Ignore the revaluation and compute. Depreciation as per IT law, okay, I got it, 13.02. I will put it in 2 digit, okay, 13.02. Deferred tax 1.80, 1.80. Loss of subsidiary 11.20, 11.20. Loss of subsidiary 11 crore 20 lakhs, 11 crore in both the cases. All of us, for a minute, please listen. Provision for gratuity. No doubt in our normal, please wait and add it. No doubt in our normal working, I will add it. But in say XJ forgings case, it was held that provision for gratuity is not a contingent liability. So no need to add it as per 115 JB format. It's an old case law. It's an old case law, not even a recent case law, not your. In that case law, they have said normal provision you will add it, normal provision you will add it, but you need not add it as per 115 JB because it is not a contingent provision. I beg to differ, but no point. In institute study material, they have mentioned this case. When you go through the study material, you need not, but generally, they have mentioned this case. So I want to be safe. Remember, this is the provision for gratuity need not be added back in 115 JB for the simple reason that it is not considered as a contingent liability only for book profit. For our normal working, 40A7 says provisions should be added back. There we add back. But in our contingent working, it need not be added. In our 115 JB working, it need not be added back. It's a judgment which is given effect to. Again, same case law, XJ forgings case, it is held that where director's son is the first or only beneficiary, the expenses will not be allowed. There should be a past history for it, otherwise it is not allowed. So 0.90, 0.90. I am taking it as an opportunity to recollect the case laws once so that it stays somewhere in our mind. 0.90. Company has undertaken a village as part of CSR. Okay, okay, and here there is nothing disallowance. These are not part of format. Okay, CSR expenditure disallowed under section 37 as per CBDT circular. Okay, so how much is there? 3.82 disallowed. Here there is nothing that doesn't warrant a disallowance over there. Technical fees paid to a subsidiary company. Total is 8.1, but FMV is 5.20. First level disallowance. All of us listen. First level disallowance. Okay. Payment in excess of fair market value to a relative. Okay. 40A subsection 2. So 8.10 minus 5.20. 2 crore 90 lakhs is disallowed because under 40A subsection 2 you have paid more than what you should pay. Under 40A subsection 2 we have paid more than what we should pay. Payment to a relative disallowed. 2 crore 90 lakhs. 2 crore 90 lakhs disallowed. Now again understand what I am saying. 30% of allowed payment. How much is allowed payment? 5.2 only is allowed into 30% as tax is not deducted in the same year. However, this is allowed in FY 21-22 as tax is deducted in April 21. This is one line having two disallowance. One disallowance under 40A subsection 2. Payment to relatives in excess of fair market value. Disallowance under TDS default. What is the TDS default disallowance? 30% of allowed expenditure. Now, I did not allow 8.1. Did I allow 8.1? No. I disallowed 2.9. So, what is allowed is only 5.2. On that only 30% can be disallowed. On that only 30% can be disallowed. Okay. So on the allowed component, I am disallowing 30%. but director is giving something more. Overdraft taken for payment of dividend allowed. For your understanding, I'll write something here. If it is interest on OD taken for payment of income tax, it will be disallowed under normal provision. Okay, so please understand, this is allowed. Dividend is allowed, only interest is not allowed. Only income tax is not allowed. Loan taken. Diminution in the value of investment 1.10, 1.10. Bonus not paid within due date disallowed under section 43B. Company has reversed it in 21-22, but it is taxable under IT law in 2021 itself. Company might be next year saying prior period, but here you should have paid the bonus before due date. 80% of the bonus were paid and the remaining 20% not paid, 1.60 into 20%. Okay, disallowed under 43B. And it is subsequently not paid, so no question of allowing it in subsequent years. Company might reverse in their books of account next year, but for me, there is nothing called prior period. Allowed as deduction, Oriental ceramic scales. Okay, so no disallowance here. It is not a capital expenditure. Neon sign boards, big boards, or normal revenue expenditure. Neon sign boards for which payment is made by unapproved modes disallowed under 40A subsection 3 is 0.02. Okay, see, this neon signboard 1.9 lakhs which they have debited to P&L, don't even worry, it is allowed. But what is disallowed is 2 lakhs was paid on a single day in cash, that is disallowed. But that too only for normal provision. That too only for normal provision. I am touching upon PGBP to a large extent. VRS compensation 1.10, I add back here nothing, 1/5 allowed as deduction because it is allowed in 5 equal installments. VRS compensation, okay, section 35 DDA says I will allow it in 5 equal installments. So entire amount cannot be paid this year, claimed this year. It can be only 1/5. it can be only 1/5 claimed this year. Okay, entire amount cannot be claimed. So, or you can disallow 4/5 also. I have taken a different stand. Feasibility study conducted expanding new areas but resulted in a failure. Okay, according to Priya Village Road Showcase, where expenditure has not resulted in creation of an asset, then such expenditure will not be allowed as deduction. Where expenditure, such expenditure will be allowed as deduction. Okay, so it has not resulted in creation of an asset. If it has created an asset, then you can capitalize it. It has not resulted in creation of an asset, so feasibility study done and the project is shelved off, you can claim the deduction. You can claim the expenditure, nothing to disallow. Cost of transformer, company has incurred the cost, but the transformer, this is like Infosys case law. There was a previous case law, Hindustan Zinc. This now for your examination, they have taken it out, where asset is created but not owned by assessee. It is given to state government. Okay, Infosys, Hindustan Zinc. Okay, this is not your Infosys. I have written traffic signal. Okay, for safe crossing of employees. The traffic signal does not belong to you. It belongs to the government. Only they can operate. Which is done. Okay, the expenditure can be claimed as deduction. Okay, can be claimed as deduction. So it is actually Hindustan Zinc where they created a pipeline from the dam, but that case loss is not there now for you. Don't worry. Infosys, you know. Regularization fee paid in Millennia Developers case, it was held. Okay, regularization fee is like penalty, hence not allowed. Regularization fee is like penalty, so not allowed. Whereas 115 JB format does not say anything like that. Donation, okay, nothing to be disallowed here. The format does not say so. Dividend from foreign company, taxable under IFOS. Okay, how much? 0.80, whereas the format does not say so. Interest taxable under IFOS. Okay, 0.30, whereas the format does not say so. Okay, sale of land taxable under PGB, capital gain. Okay, 2.45, whereas the format does not say so. Actual gratuity paid. Okay, 0.35. There I allowed the provision itself. There I allowed the provision itself. In XJ forgings, they have said that it is not a contingent liability. Very detailed question, recollecting lot of PGBPS and case laws. Okay, one question. It is not an exam question, but it gives us lot of information. Lot of information. So hold on to the solution. Hold on to the solution. Okay. Uh, Maybe 3 adjustment from this might come, 5 adjustment from this might come, 1 adjustment might from this might come, whatever it is. But I'm trying to comprehensively look at and also tell you how 115 JB has no relation with our normal working. I have put depreciation, brought forward loss or unabsorbed depreciation, whichever is less as per books. Okay. So as per books, 3.12 or 1.45 minus 1.45. I have completed just 70% of the question. Book profit under 115 JB. Okay. So lot to go. Please hold it. Hold it. It's an interesting question to understand lot of things. 234 crores is the book profit. Is the book profit under 115 JB. Business income. Business income before brought forward loss. Okay. Yes. Brought forward business loss. Brought forward business loss 1.58. Brought forward unabsorbed depreciation 4.45. Normal business income so to 38.27. I continue with my total income. All of us, book profit I have computed. All of us, please understand, I'm going to continue with my total income. Okay, please travel along with me. Okay, I know it's a lengthy question, not an examination question, but you have understood a lot of things. At the end of the day, when you look at this question, you know some case laws, 48.2, 48.3, TDS disallowances, some general disallowances, some allowable legal expenses, etc. So, lot of understandings are there. Computation of total income. Book profit, let it be there. And I'm doing it in crores only. In crores. business or profession. General business, we all know we got the total income as 239.27. Specified business income, specified business income, the computation of profit of specified business as declared in the P&L is same for income tax purpose also. So 6.15, 6.15 less brought forward specified business loss, which can be only set off against specified business income. Okay, 7.65. Okay, specified business loss to be carried forward and set off only against specified business income is still 1.5. Still 1.5. I cannot take it to the outer column to set off against my normal business income. So I need to carry forward it. I need to carry forward it. Capital gains. Capital gains. There is a sale of land. Remember, profit on sale of land as per books is 2.45. Profit on sale of land as per books is 2.45. Profit 2.45. And when I look into the information, sale consideration of the land 5.15, purchased for 2.70 in May 16. Okay, full value of consideration, which is also the net consideration because there is no expenditure, 5.15 less ICOA, less ICOA 2.70 into 301 divided by May 2016. May 2016. May 2016 is 1617. 1617, which is 264. Which is 264. Okay? 264. Repeating, 2.70 into 301 by 264. Okay, so that I get the LTCG of, okay, I get the LTCG of 2.07. I get the LTCG of 2.07. Other sources, dividend from foreign company. We all know it is not a specified foreign company and all. Nowhere they have mentioned it's a specified foreign company and oh, there is a sorry, there is a investment. Sorry. Gross LTCG exemption under 54 EC restricted to rupees 50 lakhs. Though you have invested more than that, you are restricted to 50 lakhs. Though you have invested 60 lakhs, restricted to 50 lakhs. Dividend from foreign company. Dividend from foreign company. They have not said that it is specified foreign company and all. Don't assume so. Interest 0.30. So gross total income. Gross total income 240.94. Gross total income 240.94. Deduction under section 80G, donation to Prime Minister's National Relief Fund. I think they have donated 1 crore. Okay, so total income is 239.94. Okay, okay, simple only. If you divide it into smaller parts, you know how to do that. Okay, only when you accumulate, you will find it lengthy, but the lengthy is purposefully made. Good profit is 234, normal profit is 239. That itself is a proof I am going to pay tax as per normal provision. Okay, okay. Computation of tax slowly. Okay, LTCG taxable at 20% under section 112. LTCG taxable at 20% under section 112. This into 20%. Other income assumed to be taxable at 30%. Okay, I'm assuming. Okay, this minus LTCG of 1.57. Okay, I'm taxing it at 30%. I'm assuming that the turnover is exceeding. Okay, because profit itself is so much. Okay, and surcharge. How much is the total income? 239 crores at 12%. Okay, and HEC at 4%. Total tax payable, because this will only be greater, not the other one, because the other one is the income itself is less, so 15% of that will not come. No doubt it's a lengthy question, but the understanding is deeper. 4 adjustment, 5 adjustment, 2 adjustment, 8 adjustment, 1 adjustment, how many ever comes, you now know it can be picked up from this particular question. Okay, this particular question. Our friend said that I have not put a minus sign here. Okay, income should be minus 0.3. Okay, I should have reduced here and added up there. So the answer changes a bit, but our friend wants from the top once more to look into it. 152, 48 minus 6.5, because that should not be, that is having a brought forward loss. 18.1, 16.35 minus 12.60, ignoring the evaluation. This is the depreciation as per IT law, which we found out. 1.8, 11.2, and here onwards case law oriented or section oriented is only for normal provision and not for matter. 6.65, 0.90, 3.82, 2.9, 1.56, that is 30% disallowance, diminution in the value of investment, bonus 0.32. Neon signboards are normally allowed in Oriental ceramics, but cash paid is disallowed. VRS compensation 1/5 allowed. Priya Village Roadshow, nothing disallowed. Hindustan Zinc, nothing disallowed. Millennia Developers, regularization fees is like a penalty. Donation I disallow. Other incomes I reduce it, and also the gratuity I reduce it. So that I get to 43, that 0.3. 1.58 brought forward loss and unabsorbed depreciation of 4.45. This is my working. As regards capital gain, I will disregard whatever is there as profit credited in P&L and work it out like this. Yeah, you are right. I divided it by 2 by mistake. It should be 5. Yeah, you are right, friend. It should be 5. It should be 5. Yeah. 0.22. Yes, you are right. Yeah, I take that answer. Yeah. Sorry for some small mistakes during the process of working. Thank you. Thank you. I should say thank you to you for correcting. Okay. Okay. So can we once more recollect this 115 JB? 115 JB format, starting with the appropriation, I will add back 4 things: provision, dividend, transfer to reserve, deferred taxes, provision for income tax and deferred taxes, current tax and deferred tax. Reduce deferred tax credited and transfer from reserves. Then as we progress, we also understand the 3 provisions that are provision for contingent liability, provision for diminution in investment, provision for loss of subsidiary company, and we understood provision for gratuity as far as 115 JV is concerned is not a contingent liability. 5 exemptions. Exemption under section 10 reduce. AOP share of profit reduce. 115 BBF income reduce. Patent. Foreign companies income taxable at less than 15% reduce. Okay, and notional gain from REIT reduce. The relative expenses or losses add back. Depreciation add back, ignore revaluation and reduce. I'm not asking us to you to reduce income tax depreciation. Ignore the revaluation and reduce. Brought forward loss or unabsorbed depreciation, whichever is less, as per books we should reduce. Okay. I'm going to the extension of the format. I'm going to the extension of the format. One of the aspects of aspects of extension is this: companies which are there in NCLT, either that company or its subsidiaries which are there in its NCLT with an insolvency IBC petition. In case of a company or its subsidiary whose application of insolvency is pending in a tribunal, okay, where directors are removed by the company law by the central government, the only difference is both brought forward loss and unabsorbed depreciation will be reduced. It is not whichever is less. It will be both brought forward loss and unabsorbed depreciation. I don't think that company might have book profit, book loss and all, but still, where a company's application is pending or subsidiary's application is pending under insolvency, or where directors of the company gets removed under the company law, then not just brought forward loss or unabsorbed depreciation, whichever is less, both the brought forward depreciation loss and unabsorbed depreciation can be taken. Okay. At this point, I hit at 115 JB subsection 1 and get ready to go to 115 JB subsection 2, which has Ind AS adjustment. What is that? For those who are very familiar with Ind AS balance sheet, whatever I am telling can be related. For those who are not very familiar, not seen Ind AS balance sheet, welcome to my club. I have also not seen. Nothing big and all, don't worry. Okay, right? After net profit, some fair value adjustments are made. After net profit, some fair value adjustments are made in a statement called other comprehensive income. Some fair value adjustments are made in a statement called other comprehensive income. Where am I making? After arriving net profit. So my net profit doesn't consist of it. Why I am saying this is, normally if it is debited in the net profit, I will add. If it is credited in the net profit but not allowed, I will reduce. Here, my net profit does not consist of this. So, if it is income, I should add. If it is expense, I should reduce. Normally, if it is expense, I will add back because I would have arrived at my net profit after deducting those. But here, OCI, other comprehensive income or other comprehensive items, if it is income, add back because my net profit is not reflecting that, expenses reduce. At this level, understand so much for tax purposes. Amount credited to other comprehensive income in the statement of P&L under the head I have highlighted, I have put it in a different color, items that will not be reclassified to P&L. Look for this. Items that will be reclassified, ignore. Items that will not be reclassified. Similarly, amount debited to OCI. So, if it is income, credit, add, debit, reduce, provided items will not be reclassified, will not be reclassified. However, income tax law will never recognize the concept of revaluation. Once more, income tax law will never recognize the concept of revaluation. Why I am saying so? Revaluation of tangible, revaluation of intangible, and revaluation of financial instruments should not be considered. Revaluation of tangible, this will not include revaluation of Ind AS 16 tangible, Ind AS 38 intangible, Ind AS 109 financial instrument, fair market value. Normally, amount credited to OCI in the statement of P&L under the head items that will not be reclassified to P&L should be added. However, what will not be added is a revaluation of tangible, intangible and fair valuation of financial instruments. Amount debited will be reduced. However, what will not be reduced is revaluation downward of tangible, intangible and fair valuation downward of financial instruments. Effect of fair valuation at the time of demerger: credit, add, debit, reduce. Transition reserve. What is transition reserve? Suppose, of course, I should not teach you this. The reverse is only possible. That is, you people are all Ind AS, at least from the examination and practical. I quit my practice because of Ind AS. Okay. As soon as Ind AS came, enough is enough. I came out. Okay. So, but if this is the first year I am adopting Ind AS, if this is the first year I am adopting Ind AS, my comparative balance sheet will be in AS. 2021 Ind AS, 1920 AS. How will you compare? So, the standards are framed in such a manner that 1920 should also be restated. 1920 should also be restated, and the differences that are arising will be credited or debited to transition reserve. The transition from AS to Ind AS, the transition. So the difference will be credited or debited to transition. That's like amortization. 1/5 of transition reserve, if it is credit, add back. If it is debit, reduce. However, transition reserve not to include securities premium. Revaluation reserve, never a concept. Capital reserve and forex reserve. So, 3 items are envisaged for Ind AS extension. Items that will not be reclassified to P&L: credit, add, debit, reduce. But if it is due to revaluation of tangible, intangible, financial instrument, ignore. Demerger debit, credits, add or reduce. 1/5 of transition reserve, add if it is credit, less if it is debit. Transition reserve not to include securities premium, capital reserve, revaluation reserve and forex reserve. Please read. one question with a complete graph of both Ind AS and general and Ind AS, so that we can finish and move on, okay, to other arenas of companies. Alpha Limited, which adopted Ind AS for the first time, earned a net profit of 55.75 after debit or crediting the following: provision for tax, interest, dividend distribution tax, provision for deferred tax, securities transaction tax, transfer to reserve, diminution in investment, expenditure to earn an exempt income, expenditure to earn dividend income, depreciation, including 84,000 on account of revaluation. Item credited, amount credited from special reserve, from revaluation reserve, agricultural income, domestic company dividend. Additional information: brought forward business loss and unabsorbed depreciation as per books. We should take the total and see. Particulars of other comprehensive income for the year ended. Other comprehensive income that may be reclassified into P&L, ignore it. Ignore it. It is reclassifiable. In the future, you are going to make this adjustment. Ignore it. Other comprehensive income that will not be reclassified into P&L. That is what is important to here. That will not be reclassified to P&L. That is what is important for us. Changes in revaluation surplus, deferred cost hedging, share of OCI in other associates, remeasurement of employee benefits, income tax in relation to it. Transition reserve on the convergence days 12.5, including 2.5 on capital reserve. Compute book profit and tax credit to be carried forward, assuming that the company is taxable at 25% and normal profit they have given. We need to find out the book profit only and do it. Normal profit they have given. Computation of book profit under 115 JB. $55,75,000. Provision for income tax 11,75,000. interest on income tax to be disallowed. Okay, 19,000. Dividend DTT, it's also an income tax. It is also an income tax to be disallowed. DTT 32,000. Don't worry about the paisa column. I will later correct it. Deferred tax. Okay, 1,21,000. Security transaction tax, no adjustment. No adjustment. The law has not said that need only income tax, dividend, reserves, STT need not be added. Transfer to general reserve. $5,32,000. Diminution in the value of investment. Diminution in the value of investment, 7,17,000. Expenditure to earn agricultural income. Expenditure to earn exempt income. Okay, expenditure to earn exempt income, 12,000. Expenditure to earn dividend income, no adjustment. No adjustment. Expenditure to earn dividend income, no adjustment. That is not an exempt income. Only exempt income, it's related expenditure. Depreciation, I add back 5,36,000. Depreciation, ignoring revaluation. Okay, this minus 84,000. 4,52,000. Transfer from special reserve. Transfer from special reserve, 5,24,000. Transfer from revaluation reserve, 3,18,000. 3,18,000. Agricultural income exempt under 10 subsection 1. Agriculture income exempt under 10, 9,27,000. 9,27,000. Dividend, no adjustment. It is anyhow taxable. No adjustment. No adjustment. Brought forward loss or unabsorbed depreciation, whichever is less as per books. Okay, so 50 plus 30, 80 plus 40, 120, 110 to be cumulatively seen. To be cumulatively seen, okay, on a cumulative basis. On a cumulative basis only you will see on a cumulative basis only you will see on a cumulative basis. The answer now I get is known as book profit as per section 115 JB subsection 1. The answer at this moment I get is book profit as per section 115 JB subsection 1. Subsection 1. 63 lakhs 88,000. 63 lakhs 88,000. Now I am making Ind AS adjustments. Now I am making Ind AS adjustment OCI that will that will be reclassified. No adjustments. Okay. So where it will be reclassified to P&L, I will not make any adjustment. I will not make any adjustment where it will be reclassified. OCI that will not be reclassified to P&L. That will not be reclassified to P&L. Is India is posing a threat to PCA? Let's talk about it later. Okay. Okay. OCI that will not be reclassified to P&L. Okay. That will not be reclassified to P&L. Okay. That will not be changes in revaluation surplus. No adjustment. Okay. No adjustment. Otherwise, credits I will increase, debit I will reduce. Once more, credits I will increase, debits I will reduce. Share of OCI of other associates. Share of OCI of other associates. I increase. Okay, this is in lakhs, I believe. In lakhs. So I'm working out in absolute values. Okay. Share of OCI of other 3,20,000. 3,20,000. Remeasurement of post-employment benefit. Remeasurement of post-employment benefits. Remeasurement of post-employment benefits 7,50,000. No, 4,45,000. 4,45,000. Income tax in relation to items. Okay. Income tax in relation to such items. Okay. 7,50,000. So whatever is credited other than revaluation, I will add it. Whatever is debited, I will reduce it. Deferred gains on hedges minus 7,25,000. Deferred cost of hedges minus 4,10,000. Transition reserve, transition amount on convergence date 12.5 lakhs, including capital reserve of on account of including 2.5 lakhs. Okay, I should have given credit. I should have given it as credit. Okay, right. I should have given it as credit. 1/5 of transition reserve. Okay. Okay. So 12.5 minus 2.5. Okay. 12,50,000 minus 2,50,000. Okay. Whole divided by 5. Whole divided by 5. Okay. 10 lakhs divided by 5. 10 lakhs divided by 5. transition reserve assumed to be credit. Okay. Book profit after making Ind AS adjustments. Computation of tax. Normal income. The question itself has said only 15 lakhs. Tax on such normal income 15 lakhs into 25% and HEC into 4%. Total normal tax, total normal tax 375 plus 15, 3,90,000. Total normal tax 3,90,000. Book profit, we all computed that at 6968. Okay, MAT at the rate of 15% on book profit. Okay, this into 15% and HEC at the rate of 4%. Total AMT, total MAT. Okay, right? Company is liable to pay tax either as per normal or as per MAT, whichever is higher. So the company will pay 10,87,008, where MAT is paid, then the tax credit will be carried forward. Okay, so tax credit is the difference between this and the normal tax. Tax credit where MAT is paid, tax credit will be carried forward. Okay, according to section 115JAA, maximum carry forward period 15 assessment years. Can you expand VSVS? Can you expand VSVS, my dear Rishabh? Vivad se Vishwas. No, 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 it's not. Okay, okay, right, right, friends. So this is about math computation. We will end with a question on tax credit, okay, on math, how that will work. Question number 8. For the financial year 1819, 1920, 2021, 21-22, normal income 40 lakhs, 82 lakhs, 45-90, 50-70, 55-65. How much is the tax payable and the tax credit carried forward? Read through. Financial year 1920, financial 1819, financial year 1819, normal income is 40 lakhs. Normal tax you can see 25% plus none of that is exceeding 1 crore. So 26%. I will write that working note first. Particulars, normal, mat. Okay, you can see this base rate 25-15, HEC at 4%, this into 4%, this into 4%. Effective rate 26 and 15.60. 15.60. Effective rate is 26 and 15.60. Now let's go and understand. Financial year 1819. Normal income is 40 lakhs. Taxes 40 lakhs into 26%. Okay, this is income, this is tax. Okay, this is income, this is tax. Book profit and math will go like this. Book profit is 82 lakhs and MAT is 82 lakhs into 15.60%. Okay. Therefore, MAT payable as it is higher. Tax credit to be carried forward 115 JAA. Tax credit to be carried forward is, my dear friends, 2,39,200. 2,39,200. Whenever MAT becomes payable, difference between MAT and book profit can be carried forward and adjusted in the year in which normal tax is payable. Financial year 1920. Financial year 1920. Okay. Our normal income is 45 lakhs. and book profit is 90 lakhs. Okay, tax will be 45 lakhs into 26%. Okay, and book profit tax will be 90 lakhs into 15.60%. Okay, therefore MAT is payable as it is higher. Tax credit to be carried forward 115JAA. Okay, how much? Okay, current year is 14 lakh 4,000 minus 11 lakh 70,000. Previous preceding year is another 2 lakh 39,200. So tax credit to be carried forward is 4 lakh 73,200. 4 lakh 73,200. Financial year 2021. Financial year 2021. Normal profit, okay, 50 lakhs. So the tax will be 50 lakhs into 26%. 26%. Book profit and MAT. Book profit is 70 lakhs. MAT will be 70 lakhs into 15.60%, 10 lakh 92, 10 lakh 92. Everyone to concentrate. Okay. Therefore, normal tax payable, which will be 13 lakhs. In the year in which normal tax becomes payable, the MAT credit can be brought forward and adjusted. The MAT credit 115JAA says the MAT credit can be brought forward and adjusted. Unfortunately, all of us, listen, if I bring the entire MAT credit of 473,200, my net tax payable becomes 8,26,800, but I have to pay 1092. I cannot utilize my full MAT credit in this year. Why? Because by utilizing the full MAT credit, my tax goes below minimum tax. Minimum I need to pay 1092. By utilizing the full tax credit, it goes below. Okay. However, if by utilizing it, the net tax is below MAT, then full utilization is not possible. By utilizing, if my net tax goes below MAT, full utilization is not possible. Is not possible. Hence, utilized to the extent of difference between MAT and normal profit. So what will be my utilization? This minus this. This can only be utilized 10 lakh 92 net tax payable. Net tax payable. Okay. 10 lakh 92 normal tax only I paid. I did not pay MAT. Only problem is I cannot utilize the entire credit. By utilizing the credit, what is MAT? Minimum alternative. Minimum I should pay that. Minimum I should pay that. $92. MAT credit to be carried forward. Total credit minus credit utilized. What is the total credit? 473,200 minus 1,208,000 I utilized. So this is my carry forward. This is my carry forward. So the net tax payable is very important. The net tax payable cannot be lesser than MAT. Okay? If it goes lesser, it is not acceptable. It is not acceptable. Okay? Financial year 21-22. Oh, sorry, I didn't do that. You can take it. $55 lakhs, 65 lakhs. This is the same for AMT also. This is the same for AMT. Okay, okay, right. So rarely they ask a math question. Nowadays they say ignore math, but if at all they ask on tax credit, I'm confident the class can answer. With this confidence, I move around to the next arena, that is optional tax regime. I move around to the next arena, optional tax regime. Optional tax regime is applicable only if I decide to forego. It is a mutual thing between the department, between the finance minister and the assessor. Finance minister says, I will tax you less if you forego. I am saying I will forego, tax me less. This is just optional to me, not that I have to mandatorily abide by it. It is optional to me. What should I forego? What are all the special benefits I get, I should forego. Travel along with me. What are all the special benefits I get, I should forego. What are all the special benefits I get? Exemption under 10AA for my export profit, forego. I am foregoing it in the math itself. PGBP chapter gives me some benefits. Additional depreciation, scientific research capital expenditure, specified business, deposits. Normally deposits are not given deduction, deposit based deduction, agricultural extension, skill development program. Forego everything. And also forego the deductions except 80JJ and 80M. That is forego 80I and all. I will give you. Okay. Shall we start from the first? What I should forego? Export profit exemption I should forego. Additional depreciation available to a manufacturing entity I should forego. Deposit based deduction I should forego. Scientific research I should forego. Specified business I should forego. Weighted deductions on agricultural extension and skill development programs I should forego. And all deductions except 80JJAA and 80M. 80M continues. 80JJAA, that employee pays the deduction, continues. Other things you should have foregone. If you are ready to forego, I am ready to give this. If you are ready to forego, you can pay lesser tax. Is the agreement between me and the department. And the department says, decide. You don't want optional? Fine. You want optional? Once you come in, I will close the gate. This year optional, next year normal. Once you come into optional tax regime, I am closing the gate and locking it off. You cannot exit out of the scheme. So, things foregone are foregone. There is a popular English proverb, gone bys are gone bys. You cannot get it back. Bygones are bygones. Okay? Same. Your philosophy of Hinduism, detachment. I don't want this. Forgo. If you forego, what is the benefit I give you? Some tax concessions. Two sections are there. 115BAA, any domestic company. 115BAB, manufacturing companies started after 1st October 2019. Shall we repeat once more? 115BAA, manufacturing company started before 1st October 2019, can also come there. software companies, trading companies, service sector companies, everybody. 115 BAB, only manufacturing, and it should be a new company incorporated under on or after 1st October. New company, we already know the explanation. It should not be split off of an existing company, and new plant and machinery 20% can be seconded. We have studied this. That is what is new company. Everywhere that is new company. Don't worry. Fine. So, if I opt for this, what is the rate? Rate of taxation of your core business income. Can you repeat it me? Rate of taxation of core business income, 22% base rate, 10% surcharge, 4% HEC, 25.168%. 25.168. Okay. Sorry, 15%. Typing mistake. Sorry, 15%. 15% this is. %, plus 10% plus 4%. Shall I repeat? For my core business income, especially this is important here, for the manufacturing income, 17.16%, 15 plus 10 plus 4%. Surcharge right from rupee 1. For my other income other than business income, 25.168. Here also 25.168. What is that? If you have rental income, other sources income, it will be not taxable at 17.16. 17.16 is your core manufacturing business income. If your company has any other income, it is taxable at 25.22 plus 10 plus 4. Still it is concessional rate, but it is. Income which are taxable at special rate. STCG on which STT is paid, LTCG on which STT is paid, general LTCG, winnings, such rate plus 10% plus 4%. We saw in 80I also, inter-unit transfer, cement unit transfers to infrastructure unit. A company which is opting for 115, I form a new company which is opting for 115 BAB, manufacturing. I already have an existing company. This is taxable at 30%, this is taxable at 17.16%. So what I will do? I will shift the profits here. So from here I am transferring goods at a lesser value. Inter-unit transfer only at market value. Suppose if the assessing officer makes the adjustment, transfer pricing. Income is adjusted, inter-unit transfer, not at fair market value. Adjustment made by applying the transfer pricing provision. The tax rate will be 30% plus 10% plus 4%. Don't claim any expenditure. Before going into the other provisions, can I tell you about the tax rates? For a manufacturing company which is commencing operation after 1/10/2019, which is opting for optional tax regime, the tax rates, income from manufacturing business, core business, 15 plus 10 plus 4, 17.16. Any other income, 22 plus 10 plus 4. Income which are taxable at special rates under income tax law, such rate plus 10 plus 4. Income which is increased by the assessing officer. Reason being, inter-unit transfer is not at fair market value. The income that is increased by the AO is taxable at 30 plus 10 plus 4. 4 rates for them. Normal 15%. Any other income 25%. Special rates stay as it is. FMB transfer not adhere 30%. Whereas for 115BAA, all other companies, including manufacturing companies which started before 1/10/2019, now opting for optional tax regime, only 2 rates. All incomes 25.168, income taxable at special rate, that rate plus 10% plus 4%. Brought forward loss due to unabsorbed depreciation, and that too due to additional depreciation, cannot be claimed. It's a new company, not at all applicable. Brought forward bad credit cannot be claimed, not applicable. When do you want to exercise the option? Any previous year. You claim all the benefits after that, exercise the option. Before filing, it's a new company. Before filing your first return, tell me whether you are going to go by optional or not. Once you have fallen into the scheme, there is no go, the gate is closed. We know what is new business. Take your time and read it. Take your time and read it. I'm in page number 312. Let's understand this practically. A newly established manufacturing company which commenced the operation provides you the following details and seek your opinion on the taxation following all specification. Net profit before claiming the following expenditure. Contribution for research, in-house research expenses, plant and machinery purchased in November used for the purpose of manufacture, deduction available under 80 IA. Apart from the above, the company is also owning a house property which is let out from 1st November on a monthly rent of 120. The above income is not credited to the P&L, hence not included in the net profit. Interest earned on surplus fund invested which is not included in the above P&L, 3,11,000. A limited optional tax regime, B limited normal and they are amalgamated, then which tax regime is applicable? Which amalgamated with which? If A limited has amalgamated with B limited, then B limited will continue with normal or optional. If B limited has amalgamated with A limited, then there is only optional tax regime, no other possible. Computation of income under normal tax regime. Computation of income under normal tax regime. Net profit 1 crore 80 lakhs. Less allowable expenditure. Less allowable expenditure. Contribution to national lab at 100%. How much? 20 lakhs. In-house skill expenditure. Okay. In-house scientific research expenditure at 100%. In-house scientific research expenditure at 100%, 9 lakhs. Plant and machinery purchased in November used for the purpose of manufacture. Depreciation on plant and machinery purchased in November 2020. Normal depreciation. How much is that? The plant and 1 crore 19 lakhs into 7.5%. 1 crore 19 lakhs into 7.5%. Additional depreciation 1 crore 19 lakhs into 10%. 1 crore 19 lakhs Okay. Okay. Business income house property. Okay. Rent received for 5 months, November to March. Okay. 1,20,000 into 5, 6 lakhs. 1,20,000 into 5. Standard deduction at 30%. So what happens? 4,80,000. 4,80,000. IFOS interest income. Interest income 3,11,000. Gross total income. Gross total income 1 crore 38 lakh 8,500. Deduction under section 80 IA. 100% of profits. Actually, I should not give this with 2017, it should have stopped, but electricity alone it continues. So, assuming I should not have given this, but anyhow, 14,72,000 total income. Tax on total income. Base tax, let me take it as 25%. Base tax, let me take it as 25%. Add surcharge at 7% because income has exceeded 1 crore, and HEC at 4%. Total normal tax payable. Yeah, I have given you the answer. Of the question. Standard deduction 1.8 lakhs. Thanks. Business income under optional tax regime. Business income under optional tax regime. Net profit as per P&L account. Okay, from the top, 1 crore 80 lakhs less scientific research expenditure or contribution cannot be claimed. Cannot be claimed. Okay. Depreciation on plant and machinery. Only normal can be claimed. Additional cannot be claimed. So only normal 1 crore 19 lakhs 1 crore 19 lakhs into 7.5%. 7.5%. Okay. So business income will be this minus this 1 crore 71 lakh 7,500. 1 crore because all other things cannot be claimed. Cannot be claimed. Okay. Here you got 1 crore 30 lakhs, but here you will get 1 crore 71 lakhs. House property income the same. House property income, you get the same. Okay. You get the same house property income 4,20,000. IFOS income is also the same 3,11,000. 3,11,000. Okay. Gross total income slash total income, because only 80 JJA and 80M can be claimed. So gross total income slash total income, I am getting 1 crore 63 lakh 76,500. Computation of tax under section 115 BAB. Tax at the rate of 15% on business income. Tax at the rate of 15% on business income. Tax at the rate of 22% on other incomes. Tax at the rate of 22% on house property and IFOS. And surcharge at the rate of 10%. And HEC at the rate of 4%. Total tax under optional tax regime. Total tax under optional tax regime is 31 lakhs as against our normal tax regime, where we are paying only we are paying there 34 lakhs, here 31 lakhs. So you can, even though you cannot claim scientific research, even though the rate becomes very nominal 15%, That's why this is better. And the surcharge is right from rupee 1. Question number 10. Bharatwaj Limited, a manufacturing company incorporated in 2010. So what happens is they cannot come under 115 BAB. They can only come under 115 BAA. Okay. Provides you the following particulars. Calculate optional. Net profit, debiting or crediting the following: depreciation as per book, profit on sale of machinery, interest income from deposit, dividend income from domestic company, STCG on sale of listed shares. Spouse of a director is employed in the organization for a salary of 72,000 per month. On an analysis, you find that the salary of similar employees, so 48 disallowance, payment of expenses by cross the check, 48 disallowance, donation to political party, employer and employee contribution of 185 towards a provident fund for the month of March, paid in September. Employees contribution is included in salary, employer contribution in staff welfare. Interest payable on 31st March to State Bank for purchase of machine, 50% paid in September, balance later. Contribution to a company whose main object is research. Other details: opening WDV of plant and machinery, additions less than 180 days, more than 180 days, other assets as per the rates, depreciation. Brought forward loss, business loss, unabsorbed depreciation only due to additional depreciation of last year, unabsorbed scientific research expenditure. Compute the income and tax payable, also work out the optional tax. We will do that. Read through. Interesting question. Very good understanding is going to be there. Sir, I opt for this section in the first year. Next year, adopt normal. No, it's not possible. Once you opt it, you are into the scheme. Sir, in-house skilled expenditure under optional tax regime, you cannot claim. That's what the law says. But I think revenue expenses you can claim, only capital expenditure you cannot claim. But because the law has uses the term weighted deduction, so As of now, you cannot claim. You cannot claim. Lot of understandings are going to be there. Okay. Something's very interesting also. Question number 10. Always we start with computation of depreciation, normal tax regime, plant and machinery 15%. Okay, we start with computation of depreciation. Okay, the plant and machinery 50%. Opening WDV 52 lakh 10,000. Additions less than 180 180 days or more. 180 days or more, 17 lakh 10,000. Less than 180 days, 8 lakh 40,000. Deletions. Sale value. You can see the sale value here. You can see the sale value here. Okay. Profit on sale of plant and machinery 45,000. Book value 310. So they should have sold for 3,55,000. You can see the sale value here. Profit on sale is 45,000. Book value is 310. So they should have sold for 355. Balance available for depreciation less depreciation normal 8,40,000 into 7.5% plus 74,05,000 minus 8,40,000 into 15%. Repeating 8,40,000 into 7.5% and some 65,000 or 70,000 into 15%. That is 74,500 minus 840. Additional 17 lakh 10,000 into 20% plus 8 lakh 40,000 into 10%. Closing WTV. Total depreciation under normal tax regime 1,47,750, 4,26,000 plus for all other assets, 2,80,000. For all other assets, as per the rates they have computed, 2,80,000. Total depreciation under optional tax regime. Total depreciation under optional tax regime will be this amount plus 2,80,000. You cannot claim additional depreciation. You cannot claim additional depreciation. But under normal method, you can claim additional depreciation. like how we did math, we will do and see. Okay. Computation of total income under normal provision as well as optional tax regime. Particulars, normal, optional. Net profit 2945, 29,45,000, 29,45,000. Depreciation as per books 8,05,000 in both the cases. Depreciation as per IT law, okay, okay, it is under normal tax regime 1753, whereas here it is 1327750. Interest income taxable under IFOS, how much? 7575. In both the cases, it is taxable under IFOS only. Income computation will not change. It's not a definition, it's only taxation. 115 JB only is a definition. Dividend income taxable under IFOS. Okay, 3,45,000, 3,45,000. STCG on sale of shares taxable under capital gains 3 lakhs, 3 lakhs. 40A2 disallowance in excess of FMV. So you are paying 72,000 per month to the spouse of the doctor, but similar employees are paid only 60,000. So 12,000 into 12, 144. Here also disallowed. Remember, mode of computation is not changing. Mode of computation is not changing except for special items. Only the rates of taxation changes. Okay, okay. 48, 3 disallowance. Unapproved loans. 2,75,000, 2,75,000. Donation to political party. 2 lakh, 2 lakh. Employees' contribution to PF not paid within due date as per PF law. Employees' contribution to PF, it has not been paid as per the due date under PF law to be considered as income. Subsequent payment deduction will not be allowed. So, employer and employee contribution of 1,85,000 towards PF for the month of March was only remitted in September, 1,85,000. Okay, section 224. Interest payable for purchase of machine. Interest for purchase of machine not paid within due date disallowed under 43B. Okay, so 50% paid in September 190, 50% paid means 95,000 paid, remaining 95,000 disallowed. Remaining 95,000 disallowed. Research contribution. Here comes the difference. Here it is allowed. Oh, sorry, it's debited, right? Here it is allowed, whereas here I will add it back. Research contribution under normal tax regime it is allowed, but under optional tax regime it is added back. Business income. The difference is due to depreciation and research. The difference is due to depreciation, some 4 lakhs of difference, and research of 1 lakh, 5 lakhs of difference. Capital gains. Oh, before that, okay. Brought forward loss. Here in the normal tax regime, I can accept that. Okay. Okay. Business loss. Both the places I can claim 2,10,000. Business loss. Both the places I can claim 2,10,000. Unabsorbed depreciation due to additional depreciation. Only in the normal you can claim. For the additional, for the optional tax regime, you cannot claim. Because optional tax regime, if the depreciation, if the loss is due to any of the not allowed items, you cannot. Okay? Unabsorbed scientific research expenditure. Only under normal you can claim, under optional you cannot claim. So net business income, this should be my highlighting point. Capital gains. STCG on sale of shares on which STT is paid. STCG on sale of shares on which STT is paid. Okay, 3 lakhs. Acquired in December 19, sold in November 20. Okay, right. Interest and dividend income. IFO, yes. Interest and dividend income. Because there is no ATM, I'll add it up and show. 75 plus 345. 75,000 plus 3,45,000. Okay. 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 Had there been any dividend paid, declared and paid, I would have given ATM in both the cases. I would have given ATM in both the cases. Gross total income slash total income. Deduction under section 80 GGB, political donation. Only in the normal tax regime I will get, not in the optional tax regime. Okay. lakhs only in the normal tax regime I will get. Okay, total income. 80M and 80JJAA, both the cases. But in this case, in this type of things, only in normal tax regime. I will not get it in the optional tax regime. Any deduction under 80 chapter 6A, I will not get except 80JJ, 80M and for IFSC unit 80LA. Here also same on other income at 25% in normal, 22% in optional. So 2273 minus 3 lakhs into 25% normal, whereas here okay, whereas here it is the rate is only 22%, but even then it is higher. So we are going to only go by normal, but then we complete the working. Add surcharge at 10%, not here, but here into 10%. Add HEC at 4%. This into 4%, whereas here it will be this plus this into 4%. Total tax payable so normal only is better, optional is just a working because of a lot of things. Surcharge itself is very high. Suppose, for example, this come to 30%, then also I think normal is better. Suppose if I take this as 30%, then also normal is better. Okay, a new amendment, though it is not for your year, it has been recently introduced. So please be aware of this amendment, please be aware of this working. If at all there is a question, it will be simple because it is yet to get the maturity, so it will be simple only. So the special provisions of companies 115 BBD, 115 QA buyback of shares, 115 BAA, 115 BAB, 115 JB, including Ind AS adjustments. These are special for companies. Firm, there is no chapter wise. Is there salaries, house property, PGBP, anything for company? Yeah, manufacturing company, there is this additional department, but manufacturing entities. Okay, skill development is the only thing. Capital gains, okay, it is not chapter wise, but it has lot of additional things like these aspects which are important. For a firm, we saw in section 78 a special provision in the case of reconstitution due to retirement or death of a partner. In the case of reconstitution due to retirement or death of a partner, that portion of loss which pertains to the retiring or deceased partner cannot be carried forward by the firm. Company has something larger, especially for unlisted companies, that is closely held companies. At least, listen, at least 51% of the shareholders' voting power should be held by the same persons in the year of loss and in the year of set-off. The law defines it on elimination, negative. A closely held company shall not be entitled to claim the benefit of carry forward and set off if at least 51% is not held on the last day by the same person. Okay, is not held, okay, on the, so year in which loss, year in which you want to set off, in these 2 years on the last day 31st March, 51% should be held by the same person. Then set off. Otherwise, you cannot set off. In the year of loss and in the year of set off, 2018, 31/3/2018, or for the financial year 17/18, there is loss. For after that, 31/3/21, for the financial year 2021, there is income. Can the loss of 17/18 be set off in 2021? Normally, yes, but in the case of a closely held company, whoever are the shareholders as on 31/3/18, at least 51% should be with the same persons as on 31/3/21. If yes, set off. Otherwise, no. Otherwise, no. The change can be due to death of a shareholder, obvious. Gift or inheritance, obvious. Holding company, change in the shareholding of Indian company, which is a subsidiary of a foreign company, in result of amalgamation or demerger there, provided in that country also that 51% condition continues. Remember this note, it is only for business loss and not for unabsorbed depreciation. Unabsorbed depreciation, even if there is a change, you can continue. Two stunning case laws, especially for 115JB. The two stunning case laws for 115JB before going into other questions. Normally, if you don't pay advance tax or short pay, you will be paying 234B and 234C. You will be paying 234B and 234C. Is it also applicable for MAT? Should I also estimate my MAT? Should I also estimate I will get MAT so that I need to pay advance tax? The answer is yes. Also for MAT. Why? Because there is a provision called 115JB subsection 5. All other provisions of the law will apply as it is. There is a subclause 5 which says all other provisions of the law will apply as it is. So, even you are liable to pay held by High Court. There is a specific provision in 115J which says all other provisions of law will apply. This indicates that even advance tax is applicable for a MAT computation where there is a failure. 234B and C are applicable. In Jajit question, I want to explain this, but then I thought I will come back and explain this here. LTCG on sale of land, 75 lakhs. Company has invested in 54 EC bonds, 50 lakhs. So I can claim that 50 lakhs and taxable LTCG is 75 minus 50, 25 lakhs. Taxable LTCG, 25 lakhs. All of us listen. This is correct. In MAT also, can I claim this? In MAT also, can I claim this? Why this question? Because you just now told me 115JB subsection 5, all other provisions of the law will apply. I have invested in 54 EC. So give me 50 lakhs. Actually, there were two different case laws which said no, it is not possible. MAT is format based. Will you think you would have debited this 50 lakhs in central account? You would not have, right? If it is debited, then your balance sheet is not as per accounting standards. Because this is an asset, refundable. So you would not have debited. So, well, how will I give? So they said, no, it is not acceptable. No, it will not be given. In a recent case law, Madras High Court has taken a different stand. Metal chromium case. The Madras High Court has taken a very different stand. Assessee to be eligible under 54 EAC against LTCG credited in P&L. Can this deduction be allowed in 115JB held by Madras High Court? that capital gains which forms part of the net profit in the statement of P&L in respect of which exemption is available while computing total income under regular should not be taken into account for calculation of minimum on book profits. So, that is, this exemption should also be provided, should not be taken into, doesn't mean 54 EC is not available. I've given the judgment as it is. They said pass it on. When the exemption is available under normal provision, you should pass it on to 115 JB also. There is a specific circular in our income tax law. One point is, everybody is arguing is 115 JB subsection 5, for which our circular says like this. I am going by the circular. The circular clarifies that except for substitution of tax payable under the provision and manner, all other provision relating to charge, definition, recovery, payment, assessment would apply in respect of 115 JB. Therefore, book profit for levy of MAT has to be computed in the manner laid down under 115 JB, that is by taking the adjustment specified in the explanation contained in the net profit. This implies that exemptions and deductions available under the regular provisions of the Act would not be available unless expressly provided for. For example, income exempt under 10 they have provided, 11, 12 have to be deducted. Okay, we all know income as per section 10 they are giving. And therefore, it appears that the intention of subsection 5 is to make applicable other provisions like advance tax, interest under 234 BC, penalty and prosecution, etc. The Madras High Court has, however, in this case, interpreted 115 JB 5 to also permit adjustment for 54 EC while computing MAT, even though the same is not expressly stated in 115 JB. Let's come, we are students now. Sir, there is a question, should I claim or not? You should do both things. Under 115 JB, claim it and do a reverse answer also. According to metal chromium case, allowed 50 lakhs. According to CBDT clarification circular, not allowed. Give two answers. They will not ask, they might not ask, only High Court judgment, not a Supreme Court judgment. But be prepared to give two answers. For example, in Georgette question, there I did not work out MAT because it was less. I would have claimed 50 lakhs. For example, in Georgette question, okay, this is my book profit. I can claim 50 lakhs according to metal chromium case. 50 lakhs only according to metal chromium case. According to CBDT circular, this answer is right. You can give an alternative answer. I leave it to you. If it is a theory question, which is what I predict, write a superb answer. What the metal chromium judgment says, what the CBDT circular says. CBDT circular says no, the Madras High Court has not considered one aspect, that other provisions of 115 JB5 says other provisions are applicable is only for tax collection, because 115 JB itself is a tax mechanism, tax collection like advance tax, interest, penalty, and not they are saying section 1 to section 280. They are not saying like that. That is what is the interpretation of the circular. The circular says this is only tax payable, it is only for other provision relating to charge, definition, recoveries, payment, assessment. So it is not, you cannot claim. I expect only a theory question, but I expect a theory question. If it comes neatly right, metal chromium, Madras High Court says you can claim. CBDT circular says it is applicable. You should start 115 JB subsection 5 says all other provisions will apply, but that is in relation to tax, like advance tax, interest, penalty, assessment. It is not that relating to exemptions or benefits that is given. So you can write the same wordings in a different format. The Madras High Court has, however, in this case, interpreted to also permit adjustment for, even though the same is not expressly stated. So you can conclude with this, your answer will get a better benefit. So two case laws for companies. One is 234 BC, Rolta. Another is metal chromium. Okay, both on 115 JB. Some case laws are a quick look at dividend, a quick look at deemed dividend, because the company giving loan. Loan is provided to HUF, not to the member. Member is a shareholder. Where loan is provided to HUF by a closely held company, is it taxable and dividend where the member are holding substantial interest? Yes, boss. Yes, relative also. Held by High Court that such loan indirectly benefit the substantial interest holder. Hence, such loan is also taxable. The section should be understood as loan or advance, whether directly or indirectly. I told you. Even if it is to a firm in which you are a partner, director in which company in which you are a director, it is taxable. For long, from transfer pricing provision, especially not only transfer pricing we spoke, poem we spoke. Substantial means 51%. Substantial means 51%. So, deemed dividend is not applicable if the company's substantial part of business is financing. What is the meaning? By Supreme Court, 51% of the revenue or total asset should be lending. Then only you qualify it to be main business of lending. You also lend. So I lend to a director. Your main business should be lending. And you have given the loan to a substantial interest holder. In the normal course, it is not deemed dividend. But your main business is manufacturing steel and cements. You also give employee advance. Like that, you gave director a big loan. Not acceptable. A company took Veer Vikram said is a substantial interest holder. Company took his building on lease and spent on renovation. It is not deemed dividend. For company is spending for their own purpose, their official purpose. There is no direct benefit derived by the person. Expenses are incurred for the purpose of office or to convert it into a commercial building. Trade advance will not be. Only loan. Okay, if subsidiary and the holding as debtor-creditor relationship, that cannot be considered. That cannot be considered. I'll continue tomorrow, friends. All the 4 questions are very important. I want to complete the PGBP in style. Okay. we will continue tomorrow, so that with this chapter, PGBP is over, and then we will proceed to assessment of charitable trust and cooperative society. By God's grace, I should complete it tomorrow, so that Saturday, Sunday, we discuss assessment procedure at length. Monday, Tuesday, if required, we'll extend the classes and complete it in style. Let's see. I'm not speculating anything. I know one day extension, if I ask for, you will give, but I don't want to do it.